Here's a thought experiment. Imagine you're managing a $100 billion pension fund. You want to know how your portfolio is performing against global stocks. Who do you call?
You call MSCI.
You call MSCI. And so does almost every other pension fund, sovereign wealth fund, and asset manager on Earth. That's the quiet power of this company. They don't manage the money, they measure it. And today we're going deep on MSCI Inc., ticker MSCI, after a Q1 2026 earnings report that beat on both the top and bottom line.
Revenue of $850.8 million versus the $838 million estimate, a clean beat. Adjusted EPS of $4.55 versus $4.40 expected, and the stock gained over 4% on earnings day, recovering from a 52-week low of $501 to $590. That's the setup.
I'm Hudson Thomas, she's Lana Chen, and this is Charged Alpha, the S&P 500 stock encyclopedia. Let's get into it. Section 2, Company Overview. So Lana, let me set the stage on MSCI, because I think a lot of people know the name without really knowing how this company makes money.
It's deceptively simple once you understand it. MSCI is in the business of financial intelligence. They create and license market indexes, they sell risk analytics software, they rate companies on ESG and climate factors, and they provide data tools for private assets like real estate and private equity.
4 segments. Index is the big one, about 55% of revenue. That's where the famous indexes live. The MSCI TI, the MSCI Emerging Markets Index. Asset managers and ETF providers pay MSCI a licensing fee to benchmark their funds to these indexes.
And that licensing fee has 2 components. There's a fixed subscription fee just to use the index, and then there's an asset-based fee, a small percentage of the AUM in ETFs benchmarked to MSCI indexes. Right now, approximately $15 trillion in global assets are benchmarked to MSCI indexes. $15 trillion.
That's the number I cannot get over. Analytics is the second segment, about 25% of revenue. That's the BarraOne and Risk Manager platforms, tools that portfolio managers use for risk attribution and performance measurement.
Then ESG and climate at about 12%. That's ratings, climate risk assessments, and regulatory compliance tools, primarily driven by European mandates. And private assets at about 8%. Real estate and private capital benchmarks for illiquid asset classes.
MSCI is headquartered at 7 World Trade Center in New York, founded 1998, about 6,200 employees worldwide. And the moat here is extraordinary. Once institutions build their reporting, attribution, and compliance workflows around MSCI tools, switching is a multi-year IT project. That's why their subscription net revenue retention rate has been above 95% for years.
The stickiness is the story. MSCI doesn't just sell data, they become the operating system underneath institutional investment processes. Section 3, CEO Background.
That brings us to the architect of all this, Henry Fernandez, who's been running MSCI since 1998. That's 28 years at the helm of the same company.
He was born in Panama, got his undergraduate degree from Georgetown, his MBA from Princeton. He joined Morgan Stanley in 1983, spent years in investment banking, and in 1998 was tapped to lead what was then the MSCI unit, a Morgan Stanley subsidiary.
He orchestrated the IPO in 2007 that spun MSCI out of Morgan Stanley entirely. And since then, he's transformed it from a pure index licensor into a 4-segment financial intelligence platform. The Risk Metrics acquisition in 2010, the ESG push starting around 2016, the private assets pivot starting in 2021, those are all Fernandez moves.
He's regarded as one of the most strategically gifted CEOs in financial data services. Consistent capital returns, operational discipline, and a clear long-term vision. His tone on Q1 2026 was bullish. He called out strong international index demand and expressed confidence that ESG is recovering as European regulatory clarity emerges. Section 4. The numbers.
All right, Lana, the numbers. This is your territory.
Let's start with the top line. Q1 2026 revenue was $850.8 million, up 14.1% year over year. That's a meaningful acceleration from the mid-single-digit pace of a year ago. And on a trailing 12-month basis, MSCI is doing $324 billion in annual revenue.
What's driving the acceleration?
Primarily 2 things. Index segment growth tied to record global ETF AUM. More assets benchmarked to MSCI indexes means more asset-based fee revenue, essentially on autopilot, and strong subscription retention across analytics and ESG. The company added new clients, kept existing ones, and pushed through modest price increases.
Let's talk margins.
MSCI is an asset-light business, and the margins reflect that. Gross margin is 83.3%, operating margin is 53.7%, net margin is 40.7%. These are elite numbers. For context, generating 50 cents of operating profit on every dollar of revenue while growing at 14% is not something many companies can claim.
And the stock is not cheap.
Definitely not cheap. PE is 32.8 times trailing earnings. Forward PE is about 31 times on the 2026 consensus. Price to sales is 13.4 times, high but defensible for a business with 83% gross margins and 95+% retention. EV/EBITDA is about 25.5 times. Market cap is $43.4 billion at a stock price of $590.83.
Free cash flow?
Very strong. TTM free cash flow is $1.56 billion. Operating cash flow is $1.59 billion. The FCF conversion rate is exceptional. Nearly all of operating income becomes real cash.
And the balance sheet has a nuance to it.
It does. MSCI has $385 million in cash against $6.55 billion in total debt, net debt of about $6.2 billion. And because they've been so aggressive with buybacks, shareholders' equity is actually negative $2.77 billion. That sounds alarming, but it's a deliberate financial engineering choice. They borrow cheaply and return capital to shareholders at a faster rate than they accumulate equity. As long as the business keeps generating $1.5 billion plus in free cash flow annually, the math holds.
Dividend?
Dividend yield is 1.3% with an annual dividend of 7.60 cents per share. Buyback yield is about 3.8%. Total shareholder yield just over 5%. In Q1 alone, MSCI returned $565 million, $415 million in buybacks plus $151 million dividends against $304 million in free cash flow that quarter, using credit facility capacity for the rest. Overall, MSCI's financial health is strong. The margins, the FCF generation, the subscription retention, and the revenue growth all point to a durable, compounding business. Section 5. What the Street Thinks.
Wall Street is broadly bullish on MSCI. What does the analyst picture look like?
The consensus is buy. 21 analysts covering the stock, 15 at buy, 6 at hold, 0 at sell. The average price target is $650, about 10% upside from the current $590 level. The range is $590 at the low end, $730 at the high.
Notable calls?
JP Morgan has an overweight with a 660 target, Barclays overweight at 680. Raymond James has a strong buy rating and a $700 target. Goldman Sachs at buy, $650. Wells Fargo is the outlier, equal weight at $595. There's essentially saying the stock is fairly valued here.
And the Q1 earnings report itself?
Double beat, revenue of $850.8 million versus $838 million estimated, a $12.8 million upside. Adjusted EPS of $4.55 versus $4.40 estimated. Management highlighted continued strong subscription retention and new client wins in the ESG segment. No material guidance change from the prior quarter, which is actually a positive read. No need to revise down.
And the stock responded well.
Up over 4% on earnings day. It had been sitting near its 52-week low around 501, so this report was the catalyst the bulls were waiting for. Section 6. The bull and bear case.
All right, let's lay out both sides. I'll start with the bull case.
Go ahead.
First, ETF AUM is the tailwind that never sleeps. $15 trillion in global assets benchmarked to MSCI indexes. As passive investing continues taking share from active management, every billion that flows into MSCI benchmarked ETFs generates incremental asset-based fee revenue automatically. No sales call required. The growth engine runs in the background while the company is sleeping. Second, subscription stickiness is the real moat. Net subscription revenue retention above 95% for years. Once institutional clients build reporting, attribution, and compliance workflows around MSCI tools, switching takes years. That pricing power translates into 14% revenue growth even with macro uncertainty. Third, ESG and climate is a regulatory growth engine in waiting. European mandates, SFDR, CSRD, SR, are forcing institutional investors to report on ESG and climate exposure using standardized frameworks. MSCI is the go-to provider. As that regulatory framework matures, client adoption follows. Fourth, private markets are the next frontier. MSCI's private assets segment addresses a largely unmeasured $15 trillion asset class. As institutional allocations to private equity and real estate grow, demand for standardized benchmarks in private markets is accelerating. Early innings. And fifth, capital returns machine with room to run. $565 million returned in Q1 alone, against $1.56 billion in annual FCF. The program is durable and management has consistently delivered on it.
All right, now the bear case.
Let's hear it.
The valuation leaves no room for error. At 31 times forward earnings and 13 times sales, MSCI is priced for perfection. A single quarter of subscription softness or a broader derating of high multiple financial data companies would disproportionately impact the stock, as it has in prior rate cycles. Second, asset-based fees are a hidden market dependency. Roughly 15 to 20% of index segment revenue is tied to AUM in ETFs benchmarked to MSCI indexes. A sustained equity market decline shrinks these fee streams even if subscription revenue holds. A bear market hits MSCI from two directions simultaneously. Third, ESG backlash is real in the United States. Political and regulatory pushback against ESG investing has reduced domestic demand for MSCI's ESG products. Several major U.S. asset managers have quietly pulled back on ESG commitments. That headwind is not going away quickly. Fourth, competition from LSEG is intensifying. FTSE Russell, owned by London Stock Exchange Group, has been systematically winning mandates in fixed income and factor index categories. ICE expanded its data capabilities significantly. MSCI's index franchise is dominant but not unassailable. And fifth, $6.5 billion in debt with negative equity is a tail risk. The leverage works beautifully in a stable rate environment. In a prolonged economic downturn, debt service of roughly $270 million annually constrains financial flexibility. It's not a crisis risk, but it's a constraint. Section 7. Peer comparison.
How does MSCI stack up against its peers?
MSCI trades at 13.4 times sales, 32.8 times earnings. The closest comparable is probably S&P Global. SPGI, which is a much larger enterprise that also has credit ratings layered in. SPGI trades at around 7.1 times sales and 34.5 times earnings. The lower PS reflects the ratings segment weight, dragging on overall margins.
So MSCI commands a premium on revenue but not on earnings.
Exactly. The premium PS reflects MSCI's near-pure subscription model with higher margin quality. FactSet FDS trades at about 9.2 times sales and 31.5 times earnings. Similar margins, slower growth, smaller index franchise. And Morningstar Morn is at about 7.8 times sales and 36 times earnings. They compete directly on ESG ratings and fund research.
So MSCI is the most expensive on revenue but arguably justified given the margin profile and recurring revenue mix.
That's the bull argument in one sentence. You're paying a premium for quality and predictability. The counter-argument is that you're priced for perfection in a world full of imperfections. Section 8. Options activity.
Let's look at the options market for a read on near-term sentiment.
The put-call ratio is 0.65 tilted bullish. IV is at the 42nd percentile after a pre-earnings spike, so the market has calmed down post-report. Implied volatility on the stock is about 31%.
Where's the open interest clustered?
The $580 put strike and the $620 call strike carry the highest open interest. Market sees $580 as near-term support and $620 as the upside resistance heading into summer. Implied move on the next event is about 4.5%. Skew is relatively flat. The market doesn't price in a sharp downside move. And the $620 call strike with significant open interest suggests some positioning for continued momentum through Q2. Standard reminder, options activity is a sentiment indicator, not a prediction. Options positions can be hedges, not just directional bets. Section 9. Insider activity.
Any insider action worth noting?
Modest. Over the past 6 months, there have been 4 insider sells and 0 insider buys. Net shares sold is approximately 12,000. All of the selling appears to be programmatic. 10b5-1 plan liquidations consistent with routine compensation vesting for CEO Henry Fernandez and select other officers.
No red flags?
The absence of insider buying is unremarkable. The stock is near 52-week highs, and MSCI primarily returns capital through its large corporate buyback program rather than individual insider purchases. No concentrated selling, no emergency liquidations. Section 10, Risks and Watch Points.
What are the main risks and watch points?
4 main risks to keep on the radar. First, global equity market direction. If markets fall, AUM-linked fees shrink. Second, ESG regulatory rollback in the U.S. That segment's domestic growth is already under pressure. Third, competition from LSEG and FTSE Russell in index licensing. Fourth, interest rate sensitivity on $6.5 billion in debt.
Key metrics to watch.
4 things. ETF AUM benchmarked to MSCI indexes, published weekly by BlackRock and State Street. Subscription revenue retention rate, reported quarterly. ESG and climate segment growth rate, indicator of regulatory adoption pace, and new recurring subscription sales, which drives the run rate growth.
And forward catalysts.
Q2 2026 earnings in July. First read on whether 14% growth sustains. European CSRD regulatory implementation, ESG product catalyst, MSCI Private Capital Index launches, and any index licensing mandate wins from sovereign wealth funds. Section 11, the bottom line.
Let's bring it together. What's the verdict on MSCI?
MSCI is a rare category of business. They sit at the center of institutional investing workflows worldwide. $15 trillion benchmarked to their indexes, 95% subscription retention, 83% gross margins, and 14% revenue growth. The Q1 beat on both lines confirms the fundamental thesis is intact.
The risks are real. The valuation is elevated. There's genuine ESG headwind domestically, and the debt load is something to monitor. But for long-term investors, the compounding engine here is hard to find elsewhere in financial services.
And the one metric every MSCI watcher should track: ETF assets under management benchmarked to MSCI indexes, published weekly by BlackRock and State Street. Every $1 trillion increase in that number generates roughly $30 to $40 million in additional annual asset-based fee revenue. Watch global ETF flow data every Thursday. Section 12, closing quote CTA.
We always close with a quote that captures the company. Today's is from Peter Drucker, the management philosopher who shaped how the modern corporation thinks about itself. He said, "You can't manage what you can't measure."
And that is MSCI's entire business in one sentence. They built the global standard for measurement in institutional investing, and now everything flows through them.
That's going to do it for this episode of Charged Alpha on MSCI Inc. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas. Section 13, Outrow Required Disclosure.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.